Okay, guys. So today is the part two. So last week we did the part one of the introduction to accounting. So today we are going to do the part two because we couldn't finish the full chapter of this. Chapter 4. Okay. So guys, last week I'll just summarize what we did. We studied what is accounting. We studied the benefit, the objective of accounting. The main objective is you will be providing information to interested parties so that they can make decisions. And then we studied stakeholders. They are divided into two, internal and external. Okay, internal stakeholders are the parties who are inside the business and who are interested in your business. External stakeholders, these are parties who are outside the business and interested in your business. And then we studied when it comes to accounting, the input. The input of accounting is business transactions and events. Transactions is where exchanging of resources. There are two parties involved in exchanging of resources. And then we studied events. Okay? Events. Events are where only one party one party will get the loss, the other party will get the benefit. For example, when there is a bad debt, one customer is taking your goods but not paying you the money. It's called bad debt. Yes, internal owners also internal. Okay, so then we studied the most important part, the 5 elements in accounting. We did 2 the last class. Now we have 3 more. We studied assets, we studied liabilities, okay? And then guys, assets, we know the definition. I told you, you have 3 characteristics of assets. Controlled by the business as a result of a past transaction, and you're going to get future benefits. You're going to get future benefits. So we studied, guys, assets are divided into 2, non-current and current assets. Non-current assets gives benefit for more than 1 year. Okay, and then current asset will get benefit for less than within 1 year, that is 12 months or less. A transaction is where both parties, they sacrifice something and get something. For example, I go and buy a building, I sacrifice my money and get the building. He sacrifices the building and gets the money. You understand? You exchange your resources between each other. So then, guys, we studied each and every example of non-current assets and then current assets. And then we went to liabilities. Okay. So liabilities, like assets, liabilities also have 3 characteristics. It's a present obligation. That means today we have an obligation. Why do we have an obligation today? Because of a past transaction or event. Because of a past transaction, you have an obligation today. And you know when you're settling it, you will have an outflow. Okay? Okay. Another example for event, you can even say stock loss. Okay? Or you can say cash loss. Your employee steals the money. Cash loss. You're having a cash loss because of maybe theft or something. All these losses are events. Okay. Mahmoud, I didn't understand your question. What does that mean? Okay. So guys, now let's go to the next part. Today we are going to study the 3rd element, equity. Okay, so what is equity? The value of assets that belongs to the owners of the business. Okay, now let's say, guys, you're going to start a business. Okay, now you should think you're the business. Okay, you're going to start a business. Okay, so to start a business, guys, without assets, you can never start a business. Okay, you need assets. You need assets to start a business. Why? Now, for example, let's say I want to start an institute. I need tables and chairs. I need a building. You understand? Without assets, guys, you can't start a business. Okay? So, furniture, building, the whiteboard, and all those you need to buy. So now, to buy these assets, you can either buy through the owner can bring the money. Okay? Now you need assets. So now let's say we have started a business. Okay, and then we need to buy assets. We have two sources. We can buy this asset. Let's say, guys, we need to buy a building. We need a building. Now, building, let's say it's 10 million, just assumption. Okay, now to buy this building worth 10 million, we have two sources. We can either ask from the owner to give the money, or guys, we can go and take a bank loan. You can go and take a bank loan. So guys, in order to settle this asset, in order to buy this asset, you have two sources. Either the owner can bring it, or guys, you can even take a loan. Loan is a liability. Now, what is equity? Now, let's say, guys, the owner only had 7.5 million. So that means you can't buy this building, right? You need more money. So let's say you go to the bank and ask for a loan. How much loan will you ask for? You need 10 million. You have already got from the owner 7.5 million. How much will you go and ask for the bank loan from the bank? How much will you ask? 2.5 million. You will ask 2.5 million from the bank. Okay, so that's going to be a bank loan. You know, guys, bank loan is a liability. Bank loan is a liability. Building is an asset. Now, what is the definition of equity? We say equity is the part of the value of asset which belongs to the owner. Now, tell me, guys, this 10 million building, is it fully belonging to the owner? Yes or no? 10 million worth of building, is it fully belonging to the owner? No, it's not fully belonging to the owner because the owner only contributed 7.5 million. Owner only contributed 7.5 million. So we say, guys, equity is the value of assets. The value of asset which is belonging to the owners of the business. Out of this 10 million, you know, only 7.5 million belongs to the owners. The balance 2.5 million is a bank loan. So that's why we say equity is the value of asset, not the total value, only which is belonging to the owner. So that means equity, we can come to an equation. What is equity equals to? Asset minus liability. How did I get that? See, we said asset is 10 million, liability is 2.5 million. So that means equity is 7.5 million. You understood? So this is the easiest definition. The value of asset that belongs to the owners. Okay, the value of assets which is going to belong to the owners. So how to use the equation? Equity is going to equals to asset which is 10 million minus liability which is 2.5 million. Your equity is 7.5 million. Did you all understand? You all understood, guys? Yes. In a partnership, equity belongs to the total of the partner's value. Okay. Great. Okay. Now see, guys, we have equity is affected. Okay. One of the important parts, but this is mostly you need it for chapter 2. Chapter 2, accounting equation. Okay. Accounting equation. So, guys, now see, equity is affected by four components. Due to these 4 components, your equity is going to change. Your equity changes due to these 4 components. Okay, since some of you all want me to explain again, I'll just tell once more. We say equity is the value of assets, but not the full amount. Only the part which belongs to the owner. So if you start a business, you will only buy assets. You will not have the total money. If you have the total value of the asset. Now let's say, guys, you have 10 million. Your building is also 10 million. You have 10 million. Now tell me how much is equity. Now tell me how much is equity. I repeat the question again. You say we need a building. Building is 10 million and the owner have 10 million. Now tell me, what is the value of equity? Very good. What is the value of equity? Now should the business go and take a loan? Now should the business go and take a loan? No. Why? Because the owner is having the 10 million. So if the owner is having the 10 million, owner can fully finance, the owner can fully use the building to buy the building. He can fully use his own money. So that means in that case, equity is 10 million. Now in this situation, we are telling guys, owner is not having the full money. Usually this is the practical situation. Okay, usually guys, every business, they take a loan. So that means the owner, out of this 10 million, owner only have 7.5. That means the bank, you should take a loan 2.5. So the equity is value is only 7.5 because out of this 10 million asset, owner only owns 7.5 because 2.5 was taken through a bank loan. Understood now? Now, guys, we are going to study the 4 factors which are going to affect equity. Okay, the 4 factors which will affect your equity. Very important to know this. Okay, mostly you will study this thoroughly in chapter 2. So, guys, equity increases and decreases. There are 2 factors which will increase your equity, while there are 2 factors which is going to reduce your equity. The first factor which will increase the equity. Now, usually the owner will start a business. They will mainly start to earn an income, to earn a profit, right? So if they want to earn income, the more income they earn, will the equity increase or reduce? The more income they earn, will their value increase or reduce, guys? They have started the business. Now they are earning more and more income. Tell me, guys, owner's value increases or decreases? Very good. Owner's value increases because you know when the business is earning more and more income, owner's value increases. So we say, guys, equity increases due to income. When income increases, equity will increase. The second factor which increases your equity is what you call as additional capital. What is additional capital? Now, maybe in the starting date, owner put capital worth of 7.5 million. Maybe in the 1st of January, he put 7.5 million as capital. But in the middle of the year, the owner can bring more capital. Let's say owner got some money at home. He brings more capital to the business. What do you call that? You call that additional capital. Tell me, guys, additional capital. What happens to your equity? The owner has brought more money to the business. So your equity increases or decreases? Your equity will increase again. Now put it in your head. What are the 2 factors which increase equity? Income, additional capital. Income, additional capital increases your equity. Like that, guys, there are 2 factors which will reduce your equity. 2 factors which is going to reduce your equity. So what are the 2 factors which increase your equity? Income. Income is how do you earn income? You earn income by doing the business. You earn income by doing the business. Let's say for example, I am selling stationery. By selling stationery to customers, I get income. The customers will pay me money. So I get income. So because of the income, the value of the owners will increase. That's why the owner started the business, right? And additional capital is where in the middle of the year, after the owner, at first the owner will bring capital, right? When they start the business, owner brings capital. And then guys, in the middle also, owner will bring more and more capital. Owner brings capital. He brings money from his house. Whatever he had, his personal money, he comes and puts inside the business. You call it as additional capital. So additional capital is where the owner brings more capital to the business. He puts more money to the business. He's part of money. He puts more money. So that is going to increase the capital. The students who didn't get the tune, guys, I will send you. You can put me a message to my number 077-875-9158. Okay. So you can put me a message, guys. I will send it. Okay. Almost I think 95% of the students had the tune. Okay. So guys, then after that, the third one. What decreases equity? Expenses. Now, guys, if you're a stationery business, now to sell the stationery, will you not have expenses? Will you not incur expenses? You will, right? You can't get stationery just right. You should go to a supplier and buy the stationeries. So you have expenses. You have expenses. In order to sell the stationery, you have to incur certain expenses. So what will happen to equity when there are expenses? Equity reduces due to the expenses. Equity is going to decrease. Yeah? Why? Now, okay, wait a minute. Okay, I have sent. Okay, so then guys, the next one, listen carefully. One important one, I'm going to tell drawings. What is drawings? Now the owner, he started the business. No, so now the owner will take money. Okay, the owner is going to take money from the business because now, for example, he needs money for his personal use. No, okay, he needs money for his personal use. Let's say he needs money to pay his daughter's school fees. So what he does is he comes to the business and takes money for his personal use, not for the business use. He takes money for his personal use. What do you call that in accounting? What do you call that in accounting? You call it as drawings. Drawings is where, guys, the owner takes money or any goods. Owner is taking for his personal use, not for the use of the business. He is going to take it for his own use. You call it as drawings. Okay, so drawings reduces the equity. Drawings is going to reduce the equity. Now I'll ask you all a question. Tell me, drawing reduces equity. That's correct. Now tell me, is drawings an expense? Yes or no? Is drawings an expense? Yes or no? You can answer. Is drawings an expense? Yes or no? Half of the students, y'all say yes because y'all, yeah, maybe this is the first time y'all heard this question. But I will tell y'all the answer is no. Drawings is never an expense. Please write it somewhere because this is always tested. And the students usually thinks it's a yes. Even A-levels, I have seen some students, they think, okay, drawings is an expense. No, drawings is not an expense. Drawings reduces your equity, but it's not an expense. Why? Why? Because, guys, owner is taking the money. We are not using it for business. The owner is taking for his personal use. So because of that, we say drawings is not an expense to the business. No. Drawings is not an expense to the business because owner is taking for his personal use. So that's why we say drawings is never an expense, but drawings reduces your equity. So drawings is a part of equity. If they ask you what element is drawings, you should say drawings is equity. Okay, when he puts money inside the business, it's additional capital. Now I'll ask another question. Tell me, additional capital, is it an income? Yes or no? Is additional capital an income? Yes or no? No, the answer is no. Guys, the answer is no. So now you all have learned two new stuffs. What is that? Additional capital is not an income. It's a part of equity, but it's not an income. Okay, because the owner is putting money, no. owner is putting money inside the business. Okay, so that is just a part of equity which increases your equity, but it's not an income. Drawings is not an expense because the owner is taking money for his personal use. Understood? Now then you will ask me, okay, then how do you identify whether it's income or expense? Guys, income means you are getting for your own business. Now, that means, guys, you're a stationery business. You sell stationery, you get the money. That is income. Not when the owner comes and puts money. You started a business. From the business you started, if you are getting, if you're earning something, that is income. Now, from the business you started, if you're spending, if you're incurring something, that is an expense. So do you understand the difference? Do you understand the difference? When the owner is involved, it's not an income, not an expense. Owner comes and puts money, that is going to be additional capital. Owner takes money, it can be money, it can be goods, okay? That is a drawings. So remember, capital, additional capital, drawings is equity, but additional capital increases equity, drawings reduces equity. Clear? I hope you all wrote it down somewhere. Additional capital is not an income, drawings is not an expense. Additional capital increases equity, drawings reduces equity. If they ask you what element is drawings, drawings is equity. Even though it reduces equity, we say drawings is equity. Yeah, Miss, if we has to draw. Ishfaq, I couldn't understand the values. How did you get those values? Miss, can you explain why additional capital is not an income? Because the additional capital is put by the owner. Owner is bringing money to the business. This is not because you earned, right? It's just because owner is bringing from his personal money. Income is where you're doing your business and earning. Let's say you're selling cakes. That means you're earning from the cake by selling it, not by owner putting money. Owner putting money inside the business is additional capital. Okay, so drawings, guys, drawings is an expense. Sorry, drawings is not an expense. I'm sorry. Drawings is an equity. It's not an expense. Yeah, I hope you all wrote it down. Okay. So they didn't say additional capital is income. Where does they say this is 1, this is 2, 3, 4. Yes, Sarah, that's correct. Anything you spend, if you spend for business purpose, it's an expense. If you earn for the business purpose, it's an income. Okay? So additional capital is not an income or an expense. Additional capital is a part of equity, but it's not an income. I hope you all are clear. Drawings is not an expense. Okay? So now the next one, we can even say net profit. Net profit is income minus expense. Profit is what you call as income minus expense. Tell me, profit increases equity or reduces equity? Profit increases or reduces equity? Very good. Profit will increase your equity. The more profit you have, the owner's value will increase. So profit increases equity. Now, what is a loss? What is a net loss? Income is bigger than expense, or expense is higher than income. What is a net loss? Okay, guys, net loss. Net loss is where expense is higher than your income. Expense higher than your income. So net loss, you can even include here net loss reduces equity. If it is net profit increases equity. Net profit increases equity. Net loss reduces your equity. And we go to the next part. Are you all clear? Okay. So wait, if you So Ishfaq, that's the amount he can take. If there is no money, how can he take? He can't take. Okay. So net loss. Okay, what's net loss? I will explain here. I just wanted to profit is income is when you take income, deduct expense, you call it as a profit. So when it is a profit, income is higher than your expense. Income will be higher than your expense. You call it as profit. When it is a loss, net loss, the expense is higher than your income. The expense will be higher. So this reduces equity. This increases your equity. Okay, so fine. Now let's go to the next part. Now we are going to study what is income. Safni, that's additional capital. Owner is putting his money, no? That's additional capital. Okay. So now let's go to the next part. Income. What's an income? Okay, listen carefully. Now, what did we say? Income increases equity. You all understood that, right? Income will increase your equity. So the definition is very simple. Income, what is the definition? It increases equity. It increases equity due to the increase from, except due to the increase from capital introduction by the owner. Now, you all know equity will increase due to income and additional capital. What do we say income as? We define income as equity will increase, but except due to capital. Introduction of capital. Owner putting capital inside the business is not an income. So we say the definition of income, it increases equity except due to the increase from capital introduction by owners. If the owner is introducing capital, if the owner is putting capital inside the business, that is not an income. Income is where your equity will increase, but except due to the increase from capital introduction by the owners. Understood? Let's say, for example, okay, let's say example, I will ask you all a question. Okay, you all should answer me how much is the income. Let's say equity has increased. Equity has increased, okay, by, let's say 1,000. Equity has increased by 1,000. Okay, out inside this 1,000, the owner has introduced capital. Owner has introduced capital, let's say 600. Now tell me what is income? What is income? What is the value of income? I'll repeat it again. Equity has increased by 1,000, but they are telling even though the equity increased by 1,000, owner introduced capital 600. Now read the definition again. Increase in equity except due to increase from capital introduction by the owner. So very good. Answer is 400 because equity increased by 1,000. Even though equity increased by 1,000, out of this 1,000, 600 was due to what? 600 was due to owner introducing capital. So that means that is not an income. The income is only the balance, 400. Now, did you all understand what's income? Income will increase equity, but except due to increase in capital introduction by the owner. If the owner is introducing capital, that's not an income. That's not an income. So that's why I told you all here, when I explained this, what did I tell you all? Additional capital is not an income. Additional capital is not an income. And then I told you all, drawings is not an expense. So now see the definition. We are telling income is where equity will increase, but except due to capital. Except due to capital, equity increases. So then what's the remaining? What's the remaining? If it is not capital, what's the remaining? Income. So we see, we got the definition. Equity increases, but except due to additional capital. That means the answer is income. So now you see the examples. Sales, the main income for a business. The main income for a business is sales income. What is sales? Now, we told the example, you're a stationery business. So you sell stationery. When you sell stationery, you will earn an income. The income you get by selling stationery is called sales. It depends on business by business. Let's say I am a furniture business. That means I'm selling furnitures. So then how can I earn income sales? By selling my furnitures. So if you are a business who sells pens, you can earn sales income by selling pens. So sales is going to depend on the business. So guys, we say sales is the main income for a business. For a business, what's the main income? Sales income. Okay? Okay. Yes, Sarah. Yes. Okay. Rent income. Now, how can you earn rent income? I want you all to answer me. How can we earn rent income? How can we earn rent income? Tell me. How do we earn rent income? No, you can't say. You should think you're the business now. Don't think you're in a house. You're not in a house. You're the business. Yes. Now see, let's say you have an additional building. You're the business. You have 2 buildings, guys. You have 2 buildings. So what you think is, okay, we are only using 1 building. Why don't we rent the other building? We can earn income. So when you rent out your building, when you rent out your assets, very good. When you rent out your assets, you will get rent income. Okay, so the main income for the business is sales. But other than that, if they have extra building, they can rent it out and get rent income. Okay, now how to get interest income? We studied this last week. I told you. Tell me examples how you can get interest income. Yeah, house is also asset, but we are business. No, we are not going to talk about houses. You understand? That's why I use the word building. You get it? Okay. Very good. Very good. Fixed deposit. Fixed deposit. Yeah, even we can say by giving loans to someone we can earn, but not by getting loans, by giving loans or by fixed deposit. Now, guys, you have extra money. You go and open a fixed deposit account. You go to the bank and open a fixed deposit account. So when you open a fixed deposit account, you will get every time the money. If you have money inside the fixed deposit account, you're going to get interest income, maybe monthly, maybe annually, but they will give you interest income until the money is with them. You get it? Now tell me how to get commission income. How do we get commission income? Why are we getting interest? We are getting interest because you are giving the money, right? You're giving your money for the bank. You're opening a fixed deposit account. So the money which you had, you're giving it to the bank. So when you give the money to the bank, what happens? The bank will keep the money and they will give it later after 5 years, 6 years. So they should give us something, right? So they will give interest income. Clear now? Okay, how to get commission? Guys, is my voice low today? Is my voice low? Can't you all hear me properly? No, right? Okay, I don't think my voice is never low. Okay, yeah. Okay, so maybe check your phone. Maybe there's a problem. Okay. Okay, so fine. Okay, then I'll shout and speak. Okay. Okay, what is commission? Commission income. You're getting commission income. By what you get commission income? You get commission income. Now let's say, guys, let's say you have employees. Okay, now not like that. Let's say like this. Someone is telling you, okay, now they will give you a target. Let's say they gave you a target. Okay, if you sell 1,000 stationaries, okay, if you sell 1,000 stationaries, we will give you 10% commission. 10% commission. Okay, so that means, guys, commission is where when you sell more and more. Okay, when you sell more and more, you get an income, that is commission income. Usually when you set now someone gives you a target, okay, and when you're done with the target, you get commission. So it depends. Okay, it's like this. For example, someone tells you, okay, now if you sell 1,000 goods, you get 10% income. Every time you sell one good, you get 10% income. Okay, so commission income, it is not like a salary. It depends on the number of goods you sell. Okay, who gives the commission? It depends on the business. For example, let's say you're a business and another business. Let's say you're a stationery business. Okay, let's say you're a stationery business. Okay, there is another the manufacturer. There is a manufacturer who manufactures stationeries and then give it to you. So you're like a retailer. You're like a retailer. Okay. So then this manufacturer tells you, listen, every day if you sell 100 stationaries, I will give you commission. It's like you're an agent. You get commission from the principal. Okay. Yeah, like brokers, they get commission, something like that. Understood? Now the next one, important one, discount receipt. Who gives you discount? Can you all tell me? Who gives you discount? Who will give you discount? Very good. Who gives you discount? Now you're the business. Okay, you're the business. Someone is going to give you discount when you buy goods. Who are they called? Very good. Creditors. Okay. Now see, discount receipt. Now what happens? Now you need raw materials. Okay, you need raw materials. So you're the business. Okay, you're the business. Now let's say what you do is to buy raw materials, you go to the supplier. This is the supplier. Okay, supplier. Now when you go and buy raw materials from the supplier. Okay, when you buy raw materials from the supplier, let's say you don't have money to pay him now. You go and buy raw materials, but you say him, listen, I don't have money to pay you now. Then the supplier will say, okay, you can pay me later. So that means, let's say you bought 10,000 worth of stationery. You have bought 10,000 worth of stationery. Have you paid him now? No, not yet. You haven't paid him. So then this creditor will give you a date. Let's say the creditor says, okay, so you have to pay me within this month end. So September, at the end of September, you have to pay me this 10,000. Okay, but then now after few days, so now you have purchased goods. Okay, now you have purchased goods. You have to pay how much? You have to pay 10,000. Now tell me, who is this? He is the supplier. Who is this? What is the element? What is the element? Tell me. You have purchased goods on credit. What is the element? Element, asset, liability, income or expense. Asset, liability, income or expense. Very good. Think, guys, who should pay whom? Think, who should pay whom? Now the business purchased goods on credit. That means in the future, the business have to pay the supplier. If you have to pay the supplier, it's a liability because you are payable. Please don't think in the point of view of supplier. If you think like that, you're going to make a mistake. Think you are the business. You didn't have money. You bought goods on credit. You told that you will pay later. So that means supplier here is going to be a liability. Why? Because he's a creditor. He's a creditor. Now what did I say? When should you pay? At the end of September. At the end of September. But then now the supplier needs money. He can't wait till the end of the September. So what the supplier does, supplier calls you and tells, listen, I told you should pay me at the end of September, but can you please pay me within this week? Can you please pay me within this week? Then you will ask him, okay, you told me to pay within end. I will pay within end. Then supplier says, listen, I will give you 5% discount. Let's keep it 10%. I will give you 10% discount if you pay me within this week. Without waiting till the end, if you pay me within 2 days, I'm going to give you 10% discount. So that means now this is what you call as discount received. The early you pay, you get a discount. If you pay early, you get a discount. So you call this as early settlement discount. Why? The more early you pay, you get a discount. You understood? So now he told you to pay within 2 days. Now what are you doing? You're quickly going to pay within 2 days. Now tell me, how much should you pay your supplier? He's going to give you 10% discount. If you pay within 2 days, he will give you 10% discount. My question for y'all is, if he's giving you 10% discount, how much should you pay the supplier? How much should you pay? I didn't ask you how much is the discount. I'm asking you, how much should you pay? Very good. You have to pay only 9,000. How did you get that? You know, you had to pay how much? In total, you had to pay 10,000. You had to pay 10,000. But what did he tell? He said, even though you have to pay 10,000, but if you pay within 2 days, how much you have to pay? You have to pay only 90%. Why? Because the balance 10%, he is going to give you discount. I will show you. Wait a minute. Okay, I show you. It's like this. It's like this. Okay. So now what is happening? What discount received, guys? Discount received. We can say discount received is, it is a early settlement discount. If you want, you can write, okay, early settlement discount. Or you can even say another word, cash discount. It's a cash discount. These are similar terms, cash discount. Okay, early settlement discount or cash discount. Cash discount. Okay, so now when you take early settlement discount or cash discount, there are two types. One is discount received, discount allowed. Discount received, discount allowed. Okay, discount received is an income. And even though I am explaining in depth, you always study this in the future chapters. Okay, even though I'm explaining in depth, guys, actually in this chapter only, they will not explain. Actually, this is explained in the future chapters. Okay, so this is an expense. Discount allowed is an expense. Now, income, now we are starting on the income. So I'm going to teach you discount received first, then later discount allowed. So now what did I tell? You have to pay your creditor. You have to pay your creditor how much? You have to pay 10,000. Okay, you have to pay 10,000 to your creditor. So even though you have to pay 10,000, your creditor says if you pay within 2 days, you will get 10% discount. Now let's say you're paying within 2 days. So if you pay within 2 days, you're going to get a discount of 10%. So that means, should you pay the 10,000? No, you don't have to pay 10,000. Why? Because you're going to get 10% discount. So if you get 10% discount, how much is the discount? 10,000 into 10%, you're going to get a discount of 1,000. You're going to get a discount of 1,000. So how much cash you have to pay? You will only pay cash of 9,000. You only have to pay cash of 9,000 rupees. So we say this 1,000 is an income to the business. Why do we say it's an income? Because you had to pay your creditor 10,000, but because of this discount, you should only pay 9,000. Because of that, what happened to your payment amount? It reduced from 10,000 to 9,000. Because of that, we say discount received is an income to the business. Are y'all clear? Okay, so early settlement discount or cash discount has two things: discount received, discount allowed. Discount received is an income, discount allowed is an expense. Okay, so if I was to summarize properly here, guys, you have early settlement discount. Early settlement, the word itself says if you settle early, you get the discount. Early settlement discount, or another word for this is cash discount. Cash discount. Okay, cash discount. So early settlement or cash discount is divided into two parts. What are they? Discount received, discount allowed. Discount allowed. Okay. Okay, discount received is a income. Discount allowed is a expense. Tell me, discount received, because of whom did you get this discount? Because of what did you get? Because of what? Because of what did you make you got this discount? Because you settled early, but because of whom? Because of a creditor. You get this discount. You get this discount. Okay, you receive from whom? You receive this discount from creditor. From creditor. Okay, when it is discount allowed is where, guys, the business is going to give a discount to the customer. Business is going to give a discount to the customer. Now, let's say you sell goods on credit. When you sell goods on credit, whom do you create? You create debtor. When you sell goods on credit, you create debtor. And then, guys, debtor is the customer who have to pay you money because you sold on credit. You told the customer, you can pay me later. But then after that, you need money urgently. You call him and tell, listen, pay me within 2 days. I will give you discount. So now who is giving discount? Business is giving. So now if the business is giving a discount for the business, it's an expense. So that's why we say discount allowed is an expense to the business. Why is it? For whom are you giving? You are going to give it to whom? Debtor. You give it to debtor. So remember, discount received, you're receiving from creditor. Discount allowed, you're giving to whom? Debtor. Okay, so early settlement discount is divided into two because discount received, discount allowed. It depends on who is giving to who. Discount received is creditor. Creditor gives to who? Business. Discount allowed is business gives to debtor. Understood the difference? Business gives to debtor. That's why it's an expense for us. Discount allowed is an expense. Discount received is an income because we are getting it. Discount allowed, we are giving discount. So it's an expense for us. Clear. Quickly write this down. Just a summary for y'all. Okay. So you receive this from creditor. How is creditor created? Creditor is created due to, I'll just write here, created due to what? How is creditor created, guys? Can you all tell me? How is creditor created? Very good. Due to a credit purchase. Creditor is created due to a credit purchase. Okay, fine. If you all want, I can write it down. I'll just write it down. Okay, but it will take a bit of time, but it's fine. Okay, wait a minute. I'll write it down. Okay, I think that's much clear. Okay, so now if you take, I'm repeating again, guys, this is taught in grade 10 bank, the chapter. Okay, you will study this again. Okay, so yeah, see, early settlement discount. Early settlement discounts, or we say cash discounts. Cash discounts. Okay, so cash discount, it is divided into two: discount received, discount allowed. Discount allowed. Okay, discount received is a income. Discount allowed is a expense. Okay, so discount received, from whom do you receive? You receive from creditor, you receive from creditor to the business. That's why it's an income. Why? What is discount allowed? Discount allowed is where you give discount to debtor by the business. Debtor gives discount by business. Okay. So, how is creditor created? Creditor is created due to credit purchase. Credit purchase. Okay. How is debtor created? Debtor is created due to credit sales. Credit sales. Okay. Wait a minute. Where did that go? Okay. Okay, it is created due to credit sales. Can you all write this down? It's just a summary for you all to refer in the future. Okay. How is creditor created? Creditor is created when you make a credit purchase. You make a credit purchase. That means you say, okay, I will buy the goods and pay later. Then that's how creditor is created. Clear? So the students who want this explanation again, I will be uploading this in YouTube, in our YouTube channel. You can go and watch it again. Okay, after the class, I will be uploading this again in the YouTube channel. You all can watch it again to understand further. Okay. Yes, Kamran. Yes, it's for the creditor, it's a loss. For the business, it's an income when the creditor gives a discount. Understood? Okay, fine. Okay, now let's go. Are you all done writing or you all need time? Quickly tell me so we can go to the next part. Okay, I'll send the YouTube. I will send the YouTube names in some of you all are asking. Okay. Yeah, part 1 and part 2 will be there. Okay. Part 1 and part 2 will be there. Okay, so fine. I think we can continue now. Am I right? Are you all done, right? Writing? Okay, so now let's go to expenses. Okay, let's go to expenses. Now, what is an expense? Now, if you all know the definition of income, you all can easily understand expense because same like income. Now, expense, we say expense reduces equity. Except, see, expense will decrease equity except due to drawings made by the owner. Okay, due to drawings made by the owner. Okay, wait, since you all are asking, just give me 1 minute. Okay, fine, wait. Just give me 1 minute. Wait, guys, I'll just show you all the YouTube channel because you all are asking. So the part 1 is also there for the students who, okay, this is the YouTube channel, okay? This is the YouTube channel, okay? Sateha College. If you all want, just take a screenshot so you all can watch. So here, you all can check. So this is part 1. Part 1 is here, okay? You all can check part 1. I hope now you all are clear. Okay, now let's continue. Okay, so expenses. We say, guys, expense will decrease equity. Okay, yeah, very good. Expense decreases equity, okay, but it is not due to drawings, except due to drawings made by the owner, just like income. What did we say? Income? Income equity increases, but except due to addition to introduction of capital by the owners. The expense, we say equity decreases, but except due to drawings, not because of drawings. Equity will reduce, but not just because of drawings. So that means it's an expense. Clear? Clear? See, it is a decrease in equity except due to drawings made by the owner. So you all should know additional capital is not an income, drawings is not an expense. Clear? Now guys, I will take a bit of a time and explain one by one. So if you all don't know the definition, if you all don't know what is this, it's a very good opportunity for you all to learn each and every expense type, because I'm going to explain it. Okay, so before I go to that, I'll just explain the last part. So that means this is the only thing which is remaining for this chapter. Profit. So profit is of a business is the difference between income and expense. What do you call profit as? Profit is the difference between income and expense. Okay, so that means income minus expense is you call as profit. Okay, profit. And then you know profit is increased by, tell me now guys, if the profit have to increase, should you increase your income or should you decrease your income? If you want to increase your profit, should you increase your income or should you decrease your income? Very good. You should increase your income. If you want to increase your profit, that means you have to increase your income. What about expense? Should you increase your expense or decrease your expense if you want to increase your profit? If you want to increase your profit, what should you do? Very good. You have to decrease your expense. If you decrease your expense, your profit will increase. Now are you all clear? How do we know that? See, it's a minus here. The sign is minus. So that means if this is decreasing, this will increase. Understood? So that's what it says here. Profit is increased by income and decreased by an expense. If it is an expense, profit reduces. If it's an income, profit will increase. So what's the equation of profit? Income minus expense. If income is higher than expense, it's a profit. If expense is higher than income, it's going to be a loss. If expense is higher than income, it's going to be a loss. Here, now guys, expenses, we mainly divide them into 4 parts. Okay, mainly we divide expenses into 4 parts. Administration, there are so many types of expenses. I have only given few. Administration, distribution, finance, and other. Okay, so when you go to your grade 11, you need to know to differentiate. I'll explain now itself. So that means it's going to be easy for you in the future if you're a grade 10 student. But if you're a grade 11 student, you should know, however, now itself because your exams are near. You understood? So now see, expenses, you have 4 types. Okay, administration, distribution, finance, and other. Okay, what is administration? Administration means office related expense. Okay, if you all want, I can just write it here. Okay? So what is the administration expense? Administration expense means these are office related expense. Okay, so office related expenses. Okay, that means guys, anything which you have incurred for your office purpose. Okay, Zahir Rizwan, you can put me a message to my phone number. I will send you the tune. You don't have to take a screenshot. I mean, if you want, I can send you a tune. Okay, wait. I think you want to take this working. Yeah, you can take a screenshot. It's fine. Yeah, are you done? Okay, fine. Okay, so what I was explaining, administration. Administration expense, we call them as office related expenses. Anything you incur for the office. Okay. Yeah. So since you all are asking the details, I'll just show you the details, guys. You all can, if you all want the details of my class, I'll just show you all now so that, wait. Where's that? Have got it. Just give me 1 minute. I'll show you all the details. Okay, here you go. Okay, so yeah, I will be doing a fast track program, guys, within 5 months. That is before your final exam. I will be finishing both grade 10 and 11. Usually the class will be like 3 to 4 hours per week because it's a fast track, and I will only be doing the accounting part, which is 70% of your syllabus. Okay, because business studies, you all can use self-study, guys. You all have to read and just make short notes and do questions. Okay, so what I'm doing is I will be focusing on the accounting part, the 70% of your syllabus within 5 months. Okay, so both grade 10 and 11 together. Understood? First I'll finish grade 10, then grade 11. So for now, the confirmed time is Wednesday, that is tomorrow. I will be starting chapter 2 from 2 p.m. to 4 p.m. Okay, and then after that I will keep continuing it. Okay, so if you want, just take a screenshot so that you can yeah. Okay, so I think you all are done. I'll now continue. Okay, so guys, administration expenses, these are office related expenses. Okay, that means expenses incurred for your office. Example, the first one, depreciation. Where will you study this depreciation? You are going to study this, guys, in grade 11. In grade 11 financial statements, you will be studying in depth how to calculate and all those. But I will just give a simple example. Okay, yes, the class is on Wednesdays 2 to 4. Okay, I will also put another day because 2 hours I don't think it's enough for us to finish the syllabus, so I might take another day. Okay, so administration expense, the first one is depreciation. What do you call as depreciation? Depreciation is the reduction in the value of non-current asset. Tell me, guys, when you use a building, let's say you bought a building today, maybe no, let's keep it last year. You bought a building last year. Okay, tell me, will the value of the building be the same this year or will it reduce? My question was, now let's say you bought a building 2 years ago. Now the value of the building, if you want to check the value of the building, will it be high or less than the price you bought? It will be less. It will be less. Why? Because, guys, don't think about the land. Yes, land price keeps on increasing. We are not talking about land. Except land, guys, all other assets, when you keep on using, the value reduces. For example, take your table at your home. The table, when you purchased it, will it be the same value as if you value it now? No, the table, maybe you purchased it 5 years ago. It was brand new. Can you sell it for the same price? No, you can't sell. This is what you call as depreciation. Okay, the value of non-current asset reduces. So it's an expense. Okay, it's an expense. No, every time it reduces. Every time it reduces. When you keep on using something, guys, based on the nature, when you keep on using something, the value of it will reduce, right? Value of it will reduce. Okay, I will explain you with an example. Listen carefully. Okay, for example, let's say like this. Okay, let's say you bought a furniture, a table, maybe a table. Okay, it's a non-current asset. You can use it for more than 1 year, right? You can use it for more than 1 year. You bought a table, let's say you bought in 2050. My question for you all is, in 2021, let's say you bought it for 10,000 and you sell this table for 10,000, or you have to sell it less than that. More or less? Less. Why? Because the value of the non-current asset reduced. Value of the non-current asset reduced. This is why we have to depreciate. We have to record it as an expense every year. Every year, the value of the non-current asset, when it reduces, you will go and record it as an expense. That is what you call as depreciation. For now, if you know like that, it's more than enough, because you go further in grade level. We will be studying how to calculate in depth. You will be studying in the future. Yeah. So now, see, depreciation is where your value of non-current asset, such as building, furniture, equipment, machine, keeps on reducing. Yeah. So now, how do you know if it is administration or distribution? If it is used for office purpose, such as furniture, building, machines, you are using inside the office, you put it under administration. Now tell me, motor vehicle. Motor vehicle, do you use it inside the office, or do you use it to distribute your goods, sell your goods? Motor vehicle, do you use to sell your goods, or do you use it inside your office? Usually, motor vehicle, yes, very good. You use it in order to sell goods. So that means when the motor vehicle is depreciating, when the motor vehicle is depreciating, we say it is under distribution expense. What is distribution expense? Distribution is the expense you incur to sell and distribute. Sell and distribute your goods. Any expense you incur in order to sell or distribute your goods. Okay, no, building value doesn't increase with time, guys. The land value only increases. Just think, William, the same building which you saw 5 years ago, if you go and see it now, it will be very old. Do you think the price of the building, you can sell it for higher price? No, the land price, yes, you can sell it for a higher price. I'm talking about the building, not the land. Yes, y'all are right. Land always increases. Land value always increases, except for land. All other assets, the value keeps on reducing. Understood? That's why we have to do something called depreciation. When you depreciate, your expense increases. Your expense will increase. Now, I hope you all are clear. Okay, yeah, in Sri Lanka only, there is a weird situation where your motor vehicle also increases. Okay, that's really rare, only in Sri Lanka. Okay, so fine, let's continue. Salary. You pay salary to office employees. When you pay salary to the office employees, it is an administration expense. Okay, you pay telephone. You use telephone to make calls related to business. So that is also administration, office purpose. Electricity, you use your building, you have electricity, guys. That is also going to be administration. The expense you incur on electricity. Insurance, what is insurance? Insurance is where, for example, if you have your own building, own assets, you're scared. You're scared. What if suddenly it gets due to flood, due to fire, or due to earthquake, everything destroys? What happens? You cannot use it anymore. You cannot use it anymore. So that's why you have something called insurance, where you can go to the insurance company and have an insurance policy. You will study this in a chapter called insurance. Okay. So where you will ask the insurance company, okay, when there is a flood or something, you should make sure you will compensate us. You will give us money. So then will they do it for you all for free? Will they do it for free? No, they will tell, listen, okay, we will insure. We will insure, but make sure you all always pay us premium. every month you have to pay a certain amount to the insurance company. So when there is an unfavorable situation, maybe due to flood or fire, insurance company will come and recover it. So for that, you should pay monthly or annually, you should pay insurance. Insurance premium which you pay is an administration expense. Clear? Clear? Then the next one, rent. Rent. No, insurance, there are so many insurance, guys. There are so many types, house, life, there are different types. You will study in further later. Okay? Rent. Guys, tell me, rent. How do you have rent expense? What is the situation when you have rent expense? When you take a building for rent. You don't have your own building, you go and take a building for rent. Yes, when you take a building for rent, you have to pay rent every month, you have to pay rent. So that's an expense for us. Okay, what is rates? Can someone tell me? What is called rates? Rates, what do you mean by rates? No, yeah, it's a type of tax, we can say. Rates is like this, guys. Yeah, it's like this. Now say you have your own house. Okay, you have your own house or something. Maybe your parents might pay if you go and ask them. Okay, so the municipal council or in your area, they will come and ask you every annually, usually annually, they will ask you a percentage. We call it as rates based on the value of your house. They will ask you. It's like a tax. Yes. Okay. So it's an administration expense. Okay. It's called rates. Then, guys, next one, stationery expense. Now, if you're having an office, you have to use pens, papers, rulers, all these, guys. So these are stationery expenses used in the office. So we call it as administration expense. So one student is asking, why do they ask rates? You know, government will ask for everything. The government is going to ask something. Okay, if you have money, you should always pay to the government. Okay, so if you have money in your bank account, government will ask a tax that's called debit tax. So that's how the government is. So that's how when you have your own house, yeah, that's why we say government is a stakeholder. Okay, when they have interest in your business. Understood? Okay, next one. Distribution expense. What is distribution expense? These are expenses incurred. Okay, expenses incurred to sell and distribute your goods. Okay, distribution. These are expenses. Okay, we can say incurred to sell. Expenses incurred to sell and distribute business goods. Okay, so in order to sell and distribute your goods, any expense related to, this is not bus, guys, this is business. Okay, any expense related to selling and distributing your goods comes under distribution expense. So anything related to customers, all these are distribution. I mean, any expenses you incur because of you sold to customers, or maybe in order to gain customers. What is the expense you incur in order to gain customers? In order to get more and more customers, can you all tell me what is the expense you incur? You need a lot of customers, so you have to do something. What is that? No, very good. Advertise, promote, do promotion, do advertising to get more and more customers. So yeah, that's a distribution expense. Understood? So that is all that. Now you understood how you find whether it's distribution or not. Now, if you want to, in order to sell your goods, you have to have a motor vehicle. So the value of the motor vehicle reduces every year. So that's why we say depreciation. Motor vehicle depreciation is also distribution. Then the next one, discount allowed. We studied discount allowed. I explained you all. It's an early settlement discount. This is where the business gives a discount to the debtor. When the business gives a discount, the debtor will pay you less. Let's say the debtor have to pay you 10,000. You tell him, okay, I will give you 1,000 rupees discount if you pay me tomorrow. Then the debtor will come and pay you tomorrow. Then he will only pay you 9,000. So the 1,000 is a loss for you. That's why we say it's a distribution expense, because you gave a discount. Giving a discount is an expense. Getting discount, receiving discount is an income. Understood? Now next one, bad debt. Bad debt is where you have sold goods on credit to the customers and then your customer doesn't pay you. Your customer doesn't pay you, maybe because he becomes bankrupt, or maybe your customer dies. He doesn't pay you. Okay, then you say it's a bad debt. So why did you create bad debt? Because of a credit sales. So that's why it's a distribution. Anything related to sales, if you incur expenses, it is a part of distribution. Okay, advertising. In order to gain more and more customers, you're advertising your product. So it's a part of distribution. Sales commission. Now you have a doubt. I put here also commission. Here also commission. Can someone tell me what is this sales commission? What's the difference? Here also you have commission. Here also you have commission. What's the difference? Can you tell me? Both places you have commission. Very good, guys. One commission we are getting, the other commission we are giving. When you give commission, it's an expense. When you get commission, it's an income. You understood? Just like discount received and discount allowed. When you receive discount, it's an income. When you give discount, it's an expense. When you receive commission, it's an income. When you give commission, it's an expense. Example, you have employees. You tell the employees, listen, employees, I will give you a target. If you achieve the target, you all are going to get commission. For every goods you sold, you're going to get 1% commission. So now it's an expense to the business because they have to give commission. Understood? You give commission, expense. You receive commission, it's an income. Then you will ask me how to find. Will they specifically say income or expense? Listen, guys, I'm going to tell an important point. When they just say sales commission, even though they don't say it's an expense, when they just say commission, it's always an expense. If it's an income, they will use the word income. Same goes to interest. If they just say interest, it's an expense. If it's income, they will say interest income. If they just use the word rent, it's an expense. If it's income, they will say rent income. Are you all clear? Because you all need to know how to identify. If they just say commission, interest, rent, those are expense. If it is income, they will use the word rent income or rent received, interest income or interest received, commission income or commission received. Then that's an income. Okay. Now let's go to the next one. Salesman salary. Here also you had salary. Here also you had salary. So then you will ask me, what's the difference? This is where you pay salary to the office people. This is where you pay to the salary to the office people. And what is this salary? This salary is where you pay to the people who sell your goods. There are people who will work inside the office. There are people who will go to customers and sell your goods. When you pay to the people who go to customers and sell your goods, you call them as the salesman. For them, the salary is distribution expense. Why? Because they are selling, not you're going to income. So it's distribution. Administration is when you are incurring for office people. In your exam, if they just say salary, write it under administration. If it is distribution, they will specifically say salesman salary. Clear? Next one, carriage outwards. What is carriage outwards? Carriage outward is the transportation cost you incur to sell your goods. Okay, if you all want, I'll write the meaning of carriage outwards. Okay, what's carriage outward? you should specifically say like this. Transportation, okay, it's the transport cost from where to where? From the business to the customer. From the business, the transport cost of goods. Okay, transport cost of goods from where to where? From the business to the customer is what you call as carriage outward. The transport cost you incur to sell your goods from the business to the customer. If you want, write it down. So that's why we say it's coming under distribution. Okay, one student wants me to explain that rent and all. So listen, if they just say rent, it's an expense. If it is income, they will specify rent income. If it's expense, they will just say commission. Okay, if it's income, they will use the word commission income, or they will say commission receipt. And you should understand it's an income. If it's an expense, they will just say interest. If it's an income, they will say interest income. Interest income, or they might say interest receipt. Okay, or they will say here rent income or rent receipt. This is how you identify. Or maybe here they can say rent. Sometimes they directly say rent expense, commission expense. If they don't say, always assume when they just say rent, commission, interest, these are expenses. Okay, if it's income, they are going to specify you. I hope now you're clear. Okay, now let's continue. Yes, if you just write rent, and now if it's an income, and if you just write rent, that's wrong. You should specifically say rent income. Okay, one student is asking, what is carriage outward? Carriage outward is a inward. Carriage inwards, okay, it is also an expense, but it is not a distribution. We write it under cost of sales. Okay, this is going under cost of sales. In the future, you all will study what is cost of sales. Okay, this comes under cost of sales. What is carriage inward? This is also transport cost, but this is transport cost of raw materials from where to where? From supplier to the business. Now you have to transfer raw materials from supplier to the business. That is called carriage inwards. Carriage outward is where you transport your finished good from the business to customer. Yes, Usman. If they just say rent, that means rent you have to pay. Yeah, it's an expense. Okay, rent income is the income. Yeah. Okay, carriage inwards is the transport cost of raw materials from supplier to the business. Carriage outward is the transport cost of goods from the business to customer. Carriage inwards is a part of cost of sales. It's a part of cost of sales. Okay, carriage outward, it's a part of carriage. Okay, so carriage outward, it's a part of distribution expense. Understand the difference. Okay, it's a part of distribution expense. Okay, distribution expense. No, we only pay both. We have to pay both. Okay, this also we have to pay. In order to transport goods, we go to the supplier and we take the goods. So that's carriage inwards. We go to the customer and give the goods. That's carriage outwards. Okay, so I hope you all are done. Now let's go to the next part. Finance expense. Finance expense is related to when you take a loan. Okay, you take a loan, and then guys, you go and after you take a loan, you have to pay interest. It's related to finance. Just remember, it's related to finance. What does that mean? You have taken a loan. If you have taken a loan, you have to pay interest annually or monthly. You have to pay interest. It's an expense to the business. Just because you took a loan only, you have to pay, right? So it's a part of finance. That means you have taken loan from someone. Now you have to pay interest. Or guys, another example is bank charge. Bank charge. This is where you have a current account. You have a current account in your bank. So if you have a current account, for the service they are giving, they are going to give a charge. I mean, they are going to ask you money. For the service they are giving. Now, current account holders, they will give you, the bank is going to give services to current account holders. They will tell how much money you have. They will make so many different services you will study, that is standing order payments, all those services. So for the service they are giving, they are going to make a charge for you. They will ask for a charge, that is called bank charge. And if you're a current account holder, you will have something called checkbook charge. Now that means, guys, if you're a current account holder, you have a privilege to issue checks. You can issue checks. So to issue checks, they have to print checks for each person, each current account holder. They have a stationary cost, right? So this checkbook charge is also a part of finance cost. Okay, then the last one, other expenses. Other expenses, if you can't record it under finance, distribution or administration, you go and put it under other expense. These are usually losses, stock loss, cash loss. These are very rare expenses which happen due to fire, due to maybe you have losses. So that's coming under other expenses. Donations. Okay, loss due to fire or flood. Yes, donations, something very rare. Cash frauds, very good. Something very rare. Now, donations. Donation is not a part of business activity, but you're donating your money. You're donating cash to the charity organizations. So this is not a part of your business. So that's why we say it's other expense. Donation can be goods. You donate goods, or you donate cash, or any other losses, cash loss, stock loss. So we are done with expense. Then I explain your profit, income minus expenses profit. So guys, I hope you all got benefit, you all understood stuff, I hope, from this free session. Okay. So actually we are done with the first chapter. Okay. So I think we can stop it now. So yeah, I hope you all have understood the introduction part of accounting. What is accounting? It's interesting. Believe me, accounting is really interesting chapter. Okay, more than others, I feel accounting is interesting because there are numbers, as well as it's like this, guys. If you know the logic, if you without memorizing, guys, if you understand and study, believe me, everything is simple. Everything is easy. It's up to you all to choose the way of study. Okay, don't memorize stuff. Always try to understand why did it come, how did it come. Always ask that question to yourself. Okay, so when you do that, you will automatically learn stuff better, and you will keep it for a long time in your head because you learned the correct way. You understand? So yeah, we can stop it here. If you all want the tutor or anything, guys, you all can send a message to this number 077 875 9158. Okay. So that's it for today. Take care. Bye bye.